Have Samir Dalal coming in, joining us today. Samir, hi, morning. How do you look at the entire scenario at this point in time? We expected a good rally coming in yesterday, but it fizzled out.
Yeah, so good morning, and thank you for inviting me onto the show. So, actually, I've been traveling for the last 2 weeks, and it kind of worked out well because when it came back, we came back to this good news of an agreement kind of almost finalized, which is a positive. But the problem, even though the market has rallied, and something I've said on your channel also and discussed with you all before, is that the crude prices have been higher for much longer. And because of which many companies which deal with not direct petrol and diesel at these at the petrol pumps, but they use them as the base material. Some of the derivatives of those have seen inflationary pressures, which will hurt margins, or they will have had to pass on costs, which will hurt forward consumption, right? So those things are still going to play out, and I do still believe that Q1 and Q2 for this year are going to be weak. Second thing that we got to watch out for is what the terms of the deal are and how fragile or how this deal is going to be able to stick over a longer term period. If it is able to, and if crude prices can come back to below 70, that is a positive that India will take, because then inflation going forward. So for FY27 earnings, uh, FY28 earnings, things will start normalizing and will start looking better. And then if the market wants to say, yes, FY27 can be forgotten because of the problems and we should focus more on FY28, then the markets can move forward. But then you also got to remember there's one very big factor which we are not talking about yet, I think too much, is the fact that we have a poor monsoon predicted, delayed already. And if that does not pick up anytime soon, then inflation from food articles is going to start coming, and that is going to be worse, which means that RBI will have no choice but to increase interest rates. So all of these factors, there are too many playing at this point of time, and I don't see any reason why the market should be on a runaway rally, and which is what we saw kind of yesterday. At higher levels, some amount of profit would be coming in, and I believe that is going to be the case for the next 6 months. A range-bound market, 23,000 to 24,500.
So, Samir, in the run up for when earnings turn the corner, what should your portfolio composition look like sectorally?
So obviously keep varying and changing, Aisha, right? So the sector is one of the sectors that we continue to think is something that will do extremely well over the next 2 years, 3 years, given the fact that the shift towards electric, reduction of oil, data centers may be being put up in India, which will increase the requirement of power. So that entire vertical is something that one should have at least about maybe 10 to 15%. I would still think that consumption in India is something that, even though it's going to see a slowdown over the next 2 quarters, like I told you, is something that should be heavily skewed towards, because India eventually is a consumption story. We are 1.4 billion people. We barely consume anything. We are 2,200 per capita GDP, and that needs to increase. And as that does, consumption will keep increasing. So maybe that could have 20-25% of your portfolio. IT, we still think is something that is avoidable. The healthcare is something that we need to obviously be invested. So maybe some exposure there as well. Um, Autos will come in this thing. Real estate is something we think can be a 5 to 7% component of your weightages in your holding. So it has to be a bit diversified. But instead of looking more towards sectoral allocations, I think one needs to focus more on company specific investments, because there will be certain companies who don't have a very highly levered balance sheet, who can grow and capitalize over the next 2 years. Banking and financial services, something that should at least be 20-25% of your weightage, because for India to grow, we need capex put in, and capex means debt, and these banks will start seeing a growth. And I think yesterday I was reading somewhere that for the first time in a really long time, we've seen bank lending go up to almost 17-18% in the month of May, which is a great number. So if that data is correct, I mean, I've not been able to verify, but if that is something that we are seeing, then banking is something that will do really well. And yesterday we saw that as well.
Quite interesting. So let's pick up on banks firstly, Samir. Where within banks is your tilt right now? Is it PSBs, PSUs, or rather private sector banks?
So my focus has always been more towards private sector banking. I like PSUs, I'm not denying the fact. But the bigger problem with PSUs is if difficult times happen, which is the case that may happen over the next 2 quarters if the monsoon is bad and farmers start struggling, then the government uses the banks as its proxy to kind of fund these farmers, waive some loans, do some activity in that which hurts the profitability for the short term in the PSU banks. Whereas private sector banks, uh, they are taking the risk on their book based on their own call. The ones we have been more favorable to, obviously, in the large cap HDFC Bank, for the simple reason that valuation multiples have corrected, and they have a leverage in their NIMs which can play out, which is their replacement of the HDFC Limited when they merged the bonds. They had a higher pricing, so the minute they start replacing that with CASA and that comes down, then NIMs can expand. So that is one lever that they have. And of course, the overall growth and the franchisee, the lowest cost of borrowing. So all of that works really well for an HDFC Bank. Then if you go down to slightly uh, mid-tier banks, IndusInd Bank is something that we have been very strongly recommending to people. We have ourselves invested, disclaimer, we have heavily invested in IndusInd, and we continue to like the bank. We think the worst for the bank is over. Yes, of course, if Agri faces some difficulty, they do have exposure to microfinance, and that could again become a question mark. But you see, what's happened is that exposure has already come down because of the microfinance industry struggle that happened. So that risk has obviously reduced. So we still remain very constructive and positive there. IDFC First Bank is one of the other banks that we have been very, very positive on. We think that is a great opportunity. And then if you want, you can always look at NBFCs also, something which doesn't have exposure to that space, but something like a Power Finance Corporation, which is now going to be merged with REC, right? 80% of the loan is to government entities, 85%. 15% private sector. Their opportunity in the power is so strong. We think growth is going to come back. They've only projected 10% growth. I understand that. But we think over the next 2 years that 10% will probably move up to 15% trading at one-time book value, under one-time book value on a consolidated basis. Profitable ROEs are decent. So re-rating possibility there. Then you can look at someone like a Samman Capital or a Shriram Finance, where huge money has come into these companies, which will allow them to grow for the next 3 to 4 years without having to raise further capital and lever their balance sheets higher. So, the operating leverages will play out, the profitability by itself will start going up. So these are kind of plays that one can make in the banking and in.
Interesting. Samir, you say that a Saman Capital, a Shriram Finance, they've got multi-year kind of tailwinds, especially with regard to capital. I wonder, Saman Capital has guided for what, a 1 lakh crore in terms of AUM, which ideally shouldn't be tough to do, but a 4%, 3 to 4% ROA. I'm trying to get a sense as to whether that is really doable according to you, because they are relying on cost of funds coming off very, very sharply. In your estimates or in the thesis that you're putting out, what's the realistic kind of profit number that we can expect someone to churn out?
Look, I think 4% guided ROA is a bit aggressive in the short term. Let's be very frank. Given the fact that they are going to be increasing their differentiated loan portfolio. So, right, they were historically a housing finance company. Now they're going to go into gold financing, and then they want to go into different kinds of loan book growth. So all of that is going to require a huge amount of not capex but opex, right? You're going to require new people, new branches. So all of that, when you put into place, is obviously going to mean that your cost is also going to rise. But the one advantage that they do have is they have written off, I mean, an absurd amount of money, 8,000 crore write-off. It. I'll be very frank with you. I tracked this company. I was shocked when I saw that number, right? And I was taken aback. So the advantage that they have and how they are probably going to project their 4% ROAs, that as we recover some of this 8,000 crores, because we're not saying that we're not going to work on the collection. We just cleaned up the book. We're going to work on some of that money back. And as that comes back as write backs, then what happens is that adds to your profitability and that can push your ROAs up, right? So I think that is what they have factored into their projections. And that is why maybe they feel they can achieve it. And I also do believe that write backs are going to come, not to the tune of maybe uh, I mean, ideally they should be able to write back the whole 8,000 over the next 4 years. But even if they do it progressively, that is possible. Second, the cost of funding, which you talked of coming off, absolutely it's going to come off because the minute they've already moved to double A, the minute you have strong parentage, good capital, you have a clean balance sheet, zero NPAs gross, zero NPAs net. Uh, if I am an rating company, I'm going to be like looking at this and saying, why should you not be a AAA? And the minute you move to AAA, I'm not saying it's going to happen immediately. It obviously allows you to borrow at a better rate and earn better spreads on your existing. Plus, since they're moving into higher yielding loans like gold loans and personal loans, loan against property is going to become more aggressive. They're working on a capital light model where 20% will or 30% of a loan for a prime housing will remain on their book, 70 will be sold off. When you do all of those kind of things, you can achieve high profitability. So I'm not saying 4%, but yes, I think the profitability will come and the re-rating will come because it's still trading just a little, I mean, around book value, one-time book value.
Point taken. On charts, Kunal, curious to know, Saman Capital. I also want to throw in a Bandhan Bank because they've sold off around 300 odd crore of their housing finance portfolio of bad loans, and trying to understand as to whether that could cause some bit of zing on the counter. What's your sense with regard to both of these on charts?
See, Saman Capital specifically, I would believe that that's something which is looking extremely attractive, specifically over the last 1 month, because in the last 1 month the stock has rallied very well. The volumes have improved significantly, and it's almost been like a vertical rally for Saman Capital, where the stock has moved from those 135-40 levels to 180 plus. 190 to 93 was the recent high, if I'm not wrong, for the stock, and from there it's just seen a mild cool off. But I think the way the stock has managed to see a recovery indicates that I think we could be looking at the stock coming back into the cusp of a bigger trend when volumes and such kind of a breakout happen, and when the stock prices retest the previous highs. I think if I'm not wrong, last year also the Saman Capital had shown a very big rally. The stock stagnated around the 190, 195 mark, and from there we saw a multi-month correction into the stock price. So this is the second retest for the stock price in the span of the last 10, 12 months. And I would believe that a potential breakout above this 190 mark should open up very strong legs on the upside.
Okay, Citi, they're remaining very conspicuous on how you are looking to play the entire renewable energy theme within your portfolio.
The easiest way for me to play the energy theme and take a diversified play is buying Reliance Industries. Yeah, that's something I've always focused on. Look, they have one of the best refining capacities in the country at a single location, plus their export unit, which continues to keep doing well and earning higher returns for them. So we think Reliance is one of the ways to play. Yes, MGL and IGL are very interesting plays, given the fact that this treaty has been signed, which will allow them to get their fair share of supply of gas, which is something that could have hampered their profitability with pricing going up. They're not being able to on the price hike, not getting enough supply, which also affects maybe sales on the commercial side, the CNG side, the PNG side, so they have to continue supplying. So we think the growth opportunity for these companies over the next maybe 10 years is still fantastic because we still have a huge opportunity when it comes to city gas distribution. We are at the beginning, at the tip of the iceberg. But the problem lies in the fact that gas availability has been a big concern for them. So yes, on valuation fronts, they've corrected a lot, which makes them attractive. But these become more tactical plays and not long-term plays. For me, Reliance is one of the easiest ways to play the oil and gas space by not putting all my eggs in one basket, because you get Geo plus you get the retail component. And that is how I prefer to play it rather than diversifying across two other places.
Okay, interesting. Okay, on that note, let's take a very quick break. When we come back, we'll continue our discussion with Sameer Dalal as well as Kunal Bothra.
Parekh, Vice President, Technical Research, Prabhudas Leelathar, also joining us this morning. Vaishali, I'll just come to you in a minute. Sameer, let me come to you with regard to some of these cables and wires stocks. You know, the run-up has been stupendous, especially on the likes of a Polycab. Guidance continues to be extremely positive, right? They continue to say that they'll grow faster with regard to exports, which is margin accretive for them. They're already doing 15% plus margins. There's competition coming in, and despite that, these stocks are not trading at a cheap valuation, 50 times plus in terms of price to earnings, even 1 year forward on a Polycab. How are you looking at it?
Arsh, your question sums up the answer, right? You're absolutely right when you say valuations are expensive. Look, for me, when we want to make investments, we want to see that we can make returns of 15-16% CAGR over a 2 to 3 year period. When I buy a stock at 56 times, which Polycab is trading at, yes, I am not denying maybe they'll be able to grow. But when you have competition coming in, you can say that we'll manage the competition, we'll do this. That. It's not going to always be the easiest thing because competition is going to want market share and they're going to be a bit aggressive at that point of time. So you are obviously going to have to match that competition. I heard your person rightfully say that 30% price increase has happened in the wiring space. Now that kind of tells you the inflationary pressure that is there in the space. And then when you have competition coming in, it's obviously going to be a tough task and you're not going to be able to get a re-rating in valuation. So you're going to have to play the growth story. 1 quarter or 2 quarters of faltering in the growth story for whatever reason, either on the top line or on the EBITDA, I think these stocks can get hammered by 20%, 25%. So that might be the better time to get in. I would not be in a rush to buy either RR Kabel, which is trading at 38 times, or the Polycab, which is trading at 56 times at this point of time. I think there are better opportunities in the market. You know, when you even the carb story, which is growth at reasonable pricing, neither of these two fit into that category at this point in time.
Okay, that's quite interesting. Vaishali, hi, morning. Welcome to the show. What's the trade on the index, or are you, willing to trade more the mid and the small caps, given that that's where you're seeing better traction?
Very good morning to all of you. So I think, Nifty played its part. Yesterday was a treat and we did enjoy that. So for a fresh trade in Nifty, I would say I would wait for a bit of a retracement, maybe around 23,750 or so, because near-term basis 23,900 is a hurdle, and above that we would look for a target of 24,100. So buying on dip would be recommended, not for now. And as far as Bank Nifty is concerned, we've already seen it cross the breakout levels. I mean, so I would wait for a dip in Bank Nifty as well. So I think 56,000 acts as a good support. So somewhere around 56,300, 56,400 would be an ideal trade to get into Bank Nifty. But I guess at this juncture, stock specific would be a better strategy.
Specific, the better strategy. Your calls for the day, Vaishali?
So, well, I'm looking at AU Bank. In the banking sector, I do like AU Bank. So that is one of the stocks to my liking. We have seen a good trend already. And now it seems to be getting into new round of momentum. So I'm looking at a target of its 1033 as per yesterday's close. So I would say 1,000 would be the near-term support, and I would look for a target of, first target would be 1050 and above that 1080. So this is one of the stocks that I like. And if I'm sticking on to financials, even in the cash counter, if you see M&M Finance, that's made a double bottom. So that looks pretty attractive at these levels.
Interesting. Okay. If I were to take a call with regard to some of these cables and wire stocks, Vaishali, how are they looking like on charts?
So, we have seen quite a bit of run up. So, to those who are holding, should continue holding with a trailing stop loss. but not for now. I mean, in the cash counter, phenolics, cables, etc., does look positive and can show some returns. But if we are talking about polycab, etc., I think we have seen a good run up coming in all these stocks. Polycab is already in the new, nearing the new price territory. But to those who are aggressive traders, can take 9,200 as support and look for a target of 9,800 to 10,000 in Polycab.
Real estate was the other big mover in trade yesterday. Vaishali, or calls within the real estate pack, and what are you expecting in terms of the move today? It's also expiry day.
So I would say yes. We saw, of course, we start with DLF. So DLF looks good, strong bullish candle yesterday and getting into a trend. So 580, close was 614. So 580 would act as a support, and I would look at a target of 640, 650.
Samir, I heard you also say at the start of this conversation that you like real estate. Your key plays within that space, what are you liking in particular?
Okay, so we have three stocks that we are invested in, which we continue to hold and like. The first is equities. The stock was, I mean, the company has done extremely well when it comes to its development progress. They're doing more and more tie-ups, JVs, developments. They're buying out land. So the next 2 to 3 years, what you're going to see is the cash flows coming in from all that they have done over the last 2 years. Plus their targeted guidance of growing by about 15%. I think that will bode well. And as the cash flows come in, the valuations start looking more reasonable. The other one that we think is a specific Bombay-based player, which is Keystone Reality. We think the redevelopment opportunity which they've tied up with that they're working on will do extremely well. You'll see the numbers turning around. The company's leverage had come down. They had raised money at 625 rupees per share, which is now available at 400. So I think this is a good entry point. The other one we have is Embassy Developers. It's, the stock has taken a massive beating because of one case being filed against them for 300 crores by Canara Bank against some loan that was taken by erstwhile India Bulls. I mean, not loan taken, a backstop given by India Bulls Real Estate. The company's net worth is over 10,000 crores. Even if the 300 crore payout has to happen, I don't think it's going to be the end of the story. Their development progress is extremely strong in Bangalore as well in Bombay. You're going to see again cash flows coming in. The stock would probably move up to about 100, 120, which was its previous high levels also. So over the next year and a half. So they're extremely strong and positive returns. So these are the three ones that we like and we are invested in.
Samir, great to have you then on the show. Kunal, want to pick up, the point about realty because, you were just flagging off yesterday that while I think Godrej Properties and Oberoi Realty were the first ones to actually rebound. Now you sense that underperformers like DLF, etc., may also play catch up. Reiterate that view for our viewers.
Yeah, so I think what was happening is over the last 1.5 2 months from the March lows for the real estate pack, you had 2 or 3 names which had probably performed very well. And in those were the likes of Oberoi Realty, Godrej Properties, which stocks recovered more than 30-35% from their previous major swing lows. DLF, on the other hand, was a stock which is still struggling from a level of 550 thereabouts. The stock had just about moved up towards 600 mark. So a very subpar performance for the stock. But then now on the short-term charts, it looks like that DLF is trying to come back into its own in terms of a breakout. And that too, I think at a point when the real estate sector is coming back into a recovery mode after a 10-ish short percent correction in the last 1 month. So I think in that sense, I would probably expect DLF to make a strong comeback. The stock is still below its long-term moving averages by a margin of, I think, 7-8% broadly. So I believe from the current levels of 620 thereabouts for DLF, we could be looking at a potential possibility that the stock may first come back into a retest of the 200 DMA, which should be around 660, 680 mark for the stock price. Once the breakout gets confirmed about those levels, we could be looking at a much more stronger and a more steadier recovery for DLF.
Vishali wanted your views on auto. Kunal, of course, is very bullish on the sector, but what stocks would you bet on within the pack?
So as a disclaimer, actually full auto pack has been recommended by us to our clients. So of course we started with Hyundai because that was showing great strength compared to the other stocks. So we continue to stay positive on Hyundai, but technical target resistance comes at 2100 for now. So The fresh buy strategy still comes in M&M, Force Motors, Ashok Leyland also still has got good scope for further upside potential. But since yesterday we are looking at two-wheelers are showing good strength. So Hero Moto, TVS Motors, these would be the stocks that I would now focus on.
Right, okay, that's the take coming in. Just want to check in on where the pre-open rates are settling in at and what is it that we're headed in for in trade today. There you go, just a minuscule of a move, pretty much circling around where we left it off yesterday, 70 points higher, 23,923 right now. But Kunal, strategically, would you say that mid and small caps are poised for a better move as opposed to benchmark indexes?
Absolutely, yes, Aisha, because I think we have now hit a point on the markets where the news flow, which was very pessimistic, negative over the last 5-6 months, that started to soothe out very well for the markets, which means that the confidence would start to breed in for investors to try and look at investments, look at stock-specific moves. And the reason why mid caps and small caps would remain to be a good hub for investors is because the kind of price damage on a cumulative basis for many of the mid cap names and the small cap stocks from their last 2 years high has been significant. And even after a 10, 15, 20% rally for many of the mid cap names, they're still, majority of them are still far off from their long-term peaks, long-term highs. In fact, we were looking at one of the data where the number of stocks in the mid cap and small cap universe, how far they are from their long-term moving averages. And even after the last 2 or 3 days of a swift rally for many of these names, the data still indicates that almost 40 to 50% of the stocks are still sub their 50 and their 100 moving averages, to put the least. So that itself tells us that the scope of recovery for the mid caps and the small caps could be a lot more higher once the risk on appetite comes back in a market environment like this.
I want to quickly also cover Tata Consumer. In fact, we had Citi meet with the management of Tata Consumer. They are suggesting that demand remains resilient, no visible moderation with regard to demand so far. Growth outlook remains strong, led by sustained momentum in growth businesses, Sampann, Narishco, Organic India, Capital Foods, and the like. They're also saying that commodity environment is largely benign, especially near term with regard to tea, coffee, and the like. Pricing action remains calibrated. They don't see too many price hikes, just broad-based for the moment. Margin expansion trajectory remains intact. So despite near-term pressures, they are able to kind of still continue to aspire towards the 17% kind of EBITDA margin over the long term. That's what they're really guiding for. Tata Consumer, therefore, likely to be one of those in focus. You also had a Nykaa. I'll come to Nykaa in a bit. But Vaishali, what's the take with regard to Tata Consumer?
Well, so I would say it has become a bit sluggish, but I would say the trend is intact. I mean, it is just in that consolidation phase. So according to me, this makes a good buying opportunity. We've seen the stock making a high of 1280 and then consolidating at 1100 levels. So keeping this in mind with support of 1080, I would take a buy from here, and near-term target resistance comes at 1150, which is a cluster of moving average resistance. Once we see the stock moving above that, I think it would be back on track to look for a target of 1200. So for now, it's definitely a buy with stop loss of 1080.
That on Tata Consumer, but Vaishali, we'll let you go on that note. Thanks as always for your time.